Hey YouTube, what's going on? It's Patrick here at VectorVest, and if you just clicked on this video, that means you're worried about the upcoming market crash that the media has been touting left and right, front and center all day today. Well, luckily for anybody who's been following our channel, you're probably already familiar with Evergrande. If you're not, if this is the first time you've heard that name this morning when you woke up, well, Evergrande is the second biggest real estate developer in China, and it looks like they're in a lot of hot water right now, possibly on the verge of default, and if they're one that has that issue, you can expect more to come as well. So today I've got 3 new options for you that all range from really aggressive to not really aggressive, but that can help offset any losses in your portfolio or even turn a profit in the market as the market sells off. So these are stocks that you need to keep on your radar in case the market crash, because these will add that protection layer to your portfolio to help you stay afloat. So before we get started, as always, smash that like button. If you're new here, click that subscribe button. All that helps us out, doesn't cost you a thing, and let's get into it. Alright, welcome back. So if you're new to ETFs or new to the market, ETF stands for Exchange Traded Funds, and what these are, they're baskets of different stocks or different equities or assets that you can buy as a bundle essentially. So the most commonly used example is the S&P 500. There's 500 different stocks in that index, but you can buy an ETF that will give you the access of buying all 500 stocks into one asset rather than having to buy 500 individual stocks to hold in your portfolio. So when dealing with ETFs, you have a few different options. First and foremost, you have Contra or inverse ETFs and then regular ETFs. Inverse, just as it sounds, move opposite to the underlying asset. Regular ETFs move in favor the same direction as the underlying asset. And then on top of that, you have another layer baked into it where you can add leverage to the ETF as well. So you have non-leverage and leverage ETFs. Non-leverage, just as it sounds, moves 1-to-1 to the underlying asset, and leverage means it moves at a rate of 2 or 3 times the amount of the underlying asset when the asset moves at a rate of 1. So as you can see, there's lots of different combinations of these ETFs to account for individual preferences and what fits you the best. Today, I have a mixture of double and triple leverage Contra ETFs since the market is falling, which we've been warning about here on the VectorVest YouTube channel. And what we're going to be looking at right above me, first and foremost, is QID. QID is a double leverage Contra ETF, so it moves twice as fast as the underlying asset, and it moves inverse to the underlying asset of the NASDAQ or QQQ. So as the NASDAQ 100 moves down 1%, this essentially moves up at a rate of 2%. The second one is SOX or SOXS, and this is looking at semiconductors, and this is a 3 times leverage Contra ETF. So as the semiconductors index moves down 1%, this moves up 3%. As you can see, the more leverage, the more aggressive you are, so just keep that in mind when going through these options. And then our third option is a double leverage Contra ETF or inverse ETF on oil with SCO. Now there's a few different ETFs on oil out there, especially the double leverage ones. I personally chose SCO for today just because it has higher liquidity or more average volume on a regular basis. So these 3 options are great ways to protect your portfolio if the market continues to crash. The reason why we're looking at QID is because QID or NASDAQ, the QQQ, is typically known as a heavy tech sector, and with all the issues coming out of China over the last weekend, really over the last few weeks, but really the mainstream media is just starting to point it out today, this could have a big impact on the NASDAQ, and you could see a lot of hits being taken there. Also, the NASDAQ has been one of the best performing rallies we've seen since the March lows of 2020, so therefore it has more room to fall. Then the second one we're going to look at is SOX, because if the Chinese economy starts halting or starts slowing down drastically because of all these issues coming from their housing market right now, which could roil over into other markets, then semiconductors, you could expect to see a slowdown and we could see a sell-off in those. So very similar to QQQ or the NASDAQ, but just more focused on that specific area. And then last but not least, SCO, looking at crude oil. Crude oil has been skyrocketing ever since November of 2020. And now if we start seeing a global recession, expect business to slow down. Expect to see the companies that use oil a lot for their business starting to cut back on it, which could lower the prices of oil. All right, so now that we've got those covered, let's go ahead and dive into the charts of these. As always, we'll just simply highlight all three of them here and then graph all in the upper right-hand corner. And now before we jump into these stocks, let's go over the charts. Make sure you guys are comfortable with what you're seeing, understand what you're seeing, because these are the charts I prefer to look at. So at the top, we have price shown in candlesticks with a 3 and 8 exponential moving average. When the short-term moving average is greater than the long-term, that shows short-term momentum to the upside. And when the 3 is below the 8, that shows short-term momentum in favor of the downside. And then below there, we have DPO or Detrended Price Oscillator, which is a momentum indicator. Below that, we have Stochastics, which is a great overbought, oversold scenario indicator. And then also MACD here at the bottom, which gives us a little added insight, which can show short and longer term trends on any asset you're looking at when you're looking at the chart. And then at the very bottom, we look at volume, because as we say here time and time again, volume is conviction. So with QID, what we've been noticing is QID has been steadily dropping, obviously, because the NASDAQ has been steadily rising. But looking at the momentum indicator here shown with the DPO, we can see the DPO has been steadily rising here, telling us that even though price has been going down, momentum has been steadily waning from the downside and starting to actually pick up to the upside. And we finally saw that break above that level of 0 as of today as price turned higher, and also the 3 and the 8 turned positive as well. Looking here at the Stochastic Oscillator, we can see it is below the level of 80, so therefore it's below that overbought territory, which tells us we still have some more room to run to the upside before we start getting into those lofty levels there. So we have a decent look here. Looking at volume, volume is conviction. What we're looking for with volume is a spike higher relative to what it's been trading at. So we had a big spike as of Friday's close, higher than what we've seen the last few trading days before that. That shows conviction, and as we can see, we did have some conviction on Friday leading into today's big jump. All right, so that's option number 1. Let's take a look at option number 2, SOX, Semiconductors. Semiconductors, very similar situation with what we were just seeing with QID, where price has been steadily declining over the last 6 months, but DPO has been steadily rising. And now, one thing we will take a look at, using trend lines. Trend lines can be a powerful piece to help you find the right times to get in and the right times to get out. So what we're looking at is the most recent 3 peaks here that we've seen with the highs. And as you can see, as of today, we did break above that trend line, showing that downtrend is now starting to change, turn to an uptrend, which we're seeing confirmation of with DPO. MACD's finally starting to turn positive. And Stochastics also coming out of that oversold territory, showing us that it has a lot of upside here where it's currently at. Then finally, last but not least, we have option number 3, SCO for the oil index ETF. And same situation. If we use our trend line here, we can see SCO still is in a downtrend, but it has a long way to climb before we start getting back towards that trend line to retest that downtrend. So the way you could take advantage of this is playing that difference. We see the Stochastics is finally starting to come out of oversold territory. We're also seeing a pickup in DPO. Obviously, we'd like to see that cross above 0. But if you're a little bit more aggressive, you want to jump in earlier, take on a little bit more risk for that higher potential reward. Obviously, you could do so. But if you want to play this a little bit more conservatively or a little bit more prudently, obviously, wait for the 3 and the 8 to turn positive, or the 3, that green line, to cross above the 8. Also wait for the DPO to cross above that level of 0. That way you just have a little bit more confirmation and you have a little bit more consistency in the data to help make a better decision for yourself. And so that's going to round out our 3 options for you to help protect your portfolio from an impending market crash coming up. Let me know your thoughts on these 3. Let me know what ETFs you guys are looking at. If you guys want to see another video using other ETFs, let me know in the comments down below. So until next time, take care, be safe out there, And if you want to see some other opportunities for ETFs, make sure to click on the link down in the description below and sign up for the 30-day trial. So until next time, take care, adios, toodles.